Good morning, and welcome to the Morning Brew Daily for Tuesday, February 10th, 2026. I'm your host. Every day, we bring you the stories that matter in finance, markets, and the world beyond, plus a dose of life wisdom to carry with you. Let's dive into today's headlines. Let's start with a fascinating development in the world of real-world assets, or RWAs as they're known in crypto circles. Investing Yachts has just launched an innovative yacht charter model that brings the luxury maritime industry onto the blockchain. Now, what exactly does this mean? The company is tokenizing yacht charters, allowing investors to own fractional shares of luxury vessels and earn passive income from charter operations. Think of it as the Airbnb of superyachts, but with blockchain-based ownership rights and transparent revenue distribution. This is significant because the luxury yacht market has traditionally been inaccessible to all but the ultra-wealthy. A mid-sized superyacht can cost anywhere from $10 to $50 million, plus annual operating costs of roughly 10% of the purchase price. By tokenizing these assets, Investing Yachts is democratizing access to an asset class that was previously reserved for billionaires. The RWA sector has been one of the fastest-growing areas in crypto, with total value locked in real-world asset protocols exceeding $15 billion. Yachts represent a particularly interesting opportunity because they're high-yield assets. The charter market can generate returns of 8 to 12% annually during good seasons, especially in Mediterranean and Caribbean markets. However, investors should be aware of the risks. Yacht maintenance is notoriously expensive, regulatory compliance varies by jurisdiction, and the charter market is sensitive to economic downturns. When luxury travel budgets get cut, yacht charters are often among the first discretionary expenses to go. Still, this launch signals continued innovation in bridging traditional assets with blockchain infrastructure. As regulatory frameworks mature and institutional investors become more comfortable with tokenized assets, we can expect to see more exotic asset classes following this path. Turning to the cryptocurrency markets, Litecoin has climbed an impressive 10% in recent trading, breaking out of a consolidation pattern that had held for several weeks. For those unfamiliar, Litecoin is often called the silver to Bitcoin's gold. Created in 2011 by Charlie Lee, it was designed to be a lighter, faster version of Bitcoin with a different hashing algorithm and faster block times. While it doesn't have the same store of value narrative as Bitcoin or the smart contract capabilities of Ethereum, it has maintained a loyal following and consistent usage for peer-to-peer payments. So what's driving this surge? Several factors appear to be at play. First, there's growing speculation about a potential Litecoin ETF approval. The SEC has been gradually warming up to crypto ETFs after approving Bitcoin and Ethereum products, and Litecoin, being one of the oldest and most established cryptocurrencies, is seen by many as a logical next candidate. Second, Litecoin is approaching its next halving event, scheduled for 2027. Historically, Litecoin has shown strong price appreciation in the months leading up to halvings, as the reduced block rewards decrease the supply of new coins entering the market. The current block reward of 6.25 LTC will drop to 3.125 LTC, cutting the inflation rate in half. Third, there's renewed interest in payment-focused cryptocurrencies as merchants increasingly look for alternatives to traditional payment processors with their high fees and chargeback risks. Litecoin's average transaction fee remains under 1 cent, making it attractive for everyday payments. From a technical analysis perspective, Litecoin has broken above its 200-day moving average and is testing resistance at the $120 level. If it can maintain momentum and break through this resistance, we could see a run toward the $150 range. Now let's shift gears to traditional equities and look at one of the most storied names in American business, Johnson & Johnson. Johnson & Johnson is the textbook definition of a defensive stock. Through wars, recessions, pandemics, and market crashes, J&J has continued to pay dividends for over 60 consecutive years. It's one of only a handful of companies with this distinction, earning it the coveted title of Dividend King. But J&J isn't just sitting on its laurels. The company has been executing a strategic transformation, spinning off its consumer health division into a separate company called Kenvue while refocusing on its higher-margin pharmaceutical and medical device businesses. This makes sense when you look at the numbers. The pharmaceutical division, known as Janssen, generates operating margins above 30%, while medical devices hover around 20%. The consumer business, while stable, was dragging down overall profitability with margins in the mid-teens. The pharmaceutical pipeline is particularly promising. J&J has a leading position in immunology with drugs like Stelara, which generated over $10 billion in annual sales. They're also making significant investments in oncology, with several promising therapies in late-stage trials for prostate cancer and multiple myeloma. What makes J&J particularly attractive in the current environment is its defensive characteristics. Healthcare demand is relatively inelastic, people don't stop needing medications during recessions. The company has fortress-like balance sheet strength with over $20 billion in cash and minimal debt relative to its cash flow generation. For investors looking for stability in an uncertain world, J&J offers a rare combination: a 3% dividend yield, consistent dividend growth, recession-resistant revenue streams, and a management team with a disciplined approach to capital allocation. It's not the most exciting stock in the market, but sometimes boring is beautiful. Speaking of evolution, let's talk about Netflix. The streaming giant has undergone one of the most remarkable transformations in modern business history, and the latest chapter is all about profitability and discipline. Remember when Netflix was the darling of growth investors, burning cash to acquire subscribers while the stock soared on user growth metrics? Those days are gone. Today's Netflix is a fundamentally different company, one that prioritizes free cash flow, operating leverage, and sustainable returns. The transformation has been dramatic. Netflix went from burning billions in cash annually to generating over $6 billion in free cash flow in 2025. They've cracked the code on password sharing, launched a successful ad-supported tier, and optimized their content spending to focus on what actually drives engagement. The numbers tell the story. Operating margins have expanded from single digits to nearly 25%. Subscriber growth has slowed, but revenue per user has increased as price hikes and the ad tier boost monetization. Most importantly, the company is now self-funding its content investments rather than borrowing to fuel growth. This is a mature business now, and the market is starting to treat it as such. The days of 50% annual stock gains may be behind us, but Netflix has become something arguably more valuable: a cash-generating machine with a dominant market position and significant barriers to entry. The recent Warner Bros. Discovery deal highlights Netflix's negotiating power. They're no longer the desperate upstart paying premium prices for content, they're the incumbent platform that studios need to reach audiences. This shift in bargaining power should translate into better content economics over time. For investors, Netflix represents a case study in business model evolution. Companies that can successfully transition from growth mode to profitability mode while maintaining competitive advantages often become the best long-term investments. Netflix appears to be executing this transition as well as any company in recent memory. In smaller cap news, Neoconcept has priced an $8.1 million public offering of Class A shares. While this isn't headline-grabbing money, it's worth noting as an indicator of market conditions for smaller companies. Neoconcept operates in the product design and manufacturing space, helping brands bring products to market through their integrated design, engineering, and manufacturing capabilities. They're essentially a one-stop shop for companies looking to develop and produce physical products. The fact that they were able to complete an equity offering at all is noteworthy. The IPO and secondary offering markets have been challenging for smaller companies over the past year, as higher interest rates and market volatility have made investors more risk-averse. Finally, in commodities and geopolitical news, the United States has issued fresh guidance to vessels transiting the Strait of Hormuz as tensions with Iran continue to simmer. The Strait of Hormuz is arguably the most important choke point in global energy markets. Approximately 20% of the world's petroleum consumption passes through this narrow waterway between Iran and Oman. Any disruption to shipping through the strait would have immediate and severe impacts on global oil prices. The new guidance reflects ongoing concerns about Iranian military activity in the region, including threats to commercial shipping and the potential for escalation. While the situation hasn't reached crisis levels, the fact that U.S. authorities felt compelled to update guidance suggests elevated risk perception. Oil prices have edged lower despite these tensions, suggesting that traders are more focused on demand concerns and the broader supply picture than on geopolitical risks. For energy investors and anyone watching fuel costs, the Strait of Hormuz remains a key risk to monitor. Now let's step away from markets and explore something truly extraordinary from the world of science. Researchers have finally solved one of paleoanthropology's most intriguing mysteries, putting a face to one of our long-lost relatives. A 146,000-year-old skull known as the Dragon Man, discovered in China, has been conclusively identified as belonging to a Denisovan, an extinct lineage of humans that, like the Neanderthals, interbred with our ancestors. This is a monumental discovery. For years, the Denisovans were ghost populations known only from fragmentary DNA evidence found in a Siberian cave. Scientists knew they existed, knew they interbred with early humans. Many people today carry Denisovan DNA but had no clear idea what they actually look like. The Dragon Man skull changes everything. It's remarkably well preserved for its age, showing a large cranial capacity actually exceeding modern humans, a wide face, and features distinct from both Homo sapiens and Neanderthals. What makes this discovery particularly fascinating is the location. The fact that Denisovan remains have now been found in China, thousands of kilometers from the original Siberian finds, suggests these ancient humans had a much broader geographic range than previously thought. They weren't just confined to a remote mountain valley, they were spread across Asia, interacting with early human populations throughout the continent. This discovery was recognized by Science magazine as one of the most significant breakthroughs of 2025, and rightfully so. It's a reminder that even in our modern world of satellites and smartphones, there are still profound mysteries about our own history waiting to be uncovered. For our final story, let's look at how artificial intelligence is reshaping the most mundane activity in modern life, shopping. If you think AI is just about chatbots and image generation, think again. The major tech companies are racing to turn AI into your personal shopping assistant, and the developments coming in 2026 are genuinely transformative. Google's Gemini app can now tap into the company's massive shopping graph, a dataset containing billions of products and sellers, and use its agentic technology to actually call stores on your behalf. Imagine asking your AI to find the best deal on a specific laptop, and instead of just showing you links, it negotiates with retailers, compares real-time inventory, and completes the purchase using your preferences and budget constraints. Not to be outdone, OpenAI announced a ChatGPT shopping feature that compiles comprehensive buyer's guides and has struck direct deals with Walmart, Target, and Etsy to enable purchases directly within chatbot conversations. No more switching between apps, no more endless comparison shopping, the AI handles it all. Samsung has announced plans to double its deployment of Google Gemini AI across mobile devices, aiming for 800 million units by the end of 2026. This means AI shopping capabilities will soon be in the pockets of nearly 1 billion people worldwide. We're witnessing the birth of a new layer in the commerce stack, the AI agent layer. Just as Google became the gateway to the web and Amazon became the gateway to online shopping, AI assistants are positioning themselves as the gateway to all commerce. The companies that control these agents may control the future of retail. Now, as we wrap up today's news, let's turn to something more personal. Today's life wisdom comes from one of the most influential figures in modern technology, Steve Jobs. In his legendary 2005 Stanford commencement address, Jobs shared a powerful insight about life that he called connecting the dots. You can't connect the dots looking forward, Jobs said. You can only connect them looking backwards. So you have to trust that the dots will somehow connect in your future. You have to trust in something, your gut, destiny, life, karma, whatever. This approach has never let me down, and it has made all the difference in my life. Jobs was speaking from experience. As a young man, he had dropped out of Reed College but continued attending classes that interested him. One of those classes was calligraphy, the art of beautiful handwriting. At the time, this seemed like a pointless pursuit for someone interested in computers. There was no practical application for calligraphy in the tech world of the 1970s. But 10 years later, when designing the first Macintosh computer, Jobs remembered those calligraphy classes. He insisted that the Mac had beautiful typography, multiple fonts, proportional spacing, elegant design. At the time, computers used crude block letters. Jobs' obsession with typography, born from a seemingly useless college course, helped make the Macintosh revolutionary. None of this was planned. Jobs couldn't have predicted that calligraphy would matter to computers. He simply followed his curiosity, trusting that the knowledge would somehow be valuable. This is the essence of connecting the dots looking backwards. When we look forward, the path is always unclear. We can't predict which skills will matter, which relationships will prove crucial, which opportunities will lead somewhere meaningful. The only way to make sense of it is to look back and see how seemingly random experiences woven together into the tapestry of our lives. Jobs' message is profound: have the courage to follow your curiosity and intuition, even when you can't see where they lead. Don't demand immediate utility from everything you learn. Don't only pursue what seems practical or career advancing in the moment. Trust that the dots will connect. So what dots are you collecting? What skills are you learning that seem unrelated to your current path? What relationships are you building without knowing exactly why? What curiosities are you following simply because they fascinate you? Don't dismiss these experiences because you can't see their purpose. 10 years from now, you may look back and realize they were essential preparation for something you couldn't have imagined. The dots will connect. Trust the process. That wraps up today's Morning Brew Daily for Tuesday, February 10th, 2026. Thanks for joining me on this journey through markets, science, technology, and life wisdom. Remember, the world is complex and fascinating, there's always more to learn, more to explore, more dots to collect. Until tomorrow, stay curious, stay informed, and trust that your path will make sense in time. Good morning, and good day.